Hi everyone, Natu is here again, back with another video. In this video, I'm going to show you the logic and the math behind the raise repeat account from raises.com and why it just makes logical sense. Alright, hello everyone, Natu here again, back with another video, and in this video, we're just going to do a little ROI. We call it ROI justification. We call it expected value calculation. Basically, we're going to use math. We're going to use, this can be something that a lot of people who are watching this are actually raising capital for their deal and they're selling it to investors, obviously in a compliant way. And we're seeing it, this can be a good tool for you to sell investors if you understand how to use probabilities and how to construct an argument with probabilities. We're going to use the expected value formula to construct an argument for you to be able to show investors that your deal is something worth pursuing. And on the flip side, we're also going to use this to show people, we're also going to use this to show you why raises.com is built the way it's built to reduce the risk of you losing money out of pocket. All of the same formula and the same thing. So it's going to be two birds in one stone. So just bear with me. So what it really is, the expected value, and what really is all this, and you're probably going to see a bunch of, you see sigma, you see all this stuff, and it looks scary. So what really is all this stuff and these blue and red numbers? So I'll give you a really good example. I was reading a great book by Richard Koch, and he was talking about his investment philosophy of how he invests in companies and he multiplied the probability of the investments making him money. He multiplied the probability of it by the amount of money he would make. For example, if he assumed that he had a 10% chance of an investment making him $1 million, he would just multiply 10, by like 10% by $1 million, and then to him that investment was worth 100,000. That's one example. And so I thought about this, and then I started applying this to different things. For example, I was once offered to purchase an exempt market dealer, which is, in other words, is a Canadian version of a broker dealer. And obviously, if I'm offered it, I have to obviously ask questions. And I thought about it, and there was a deal that they were working on, and there was based on what I saw, there was probably a 10% chance of the deal closing, and I was being really generous. And the deal didn't actually close. And when time came for things to actually happen, there was so the deal was worth $400,000 for me personally. And multiplying the probability of 10% by 400,000, I saw 40,000. And I was like, the chance of me, like, compared to the other things I wanted to do and the expected money I'll make in other things and the value of that, to me, it wasn't worth it. So this thing has really saved me personally. And even in looking at building, somebody who builds a business, if you're building a business or a fund or whatever, and you have somebody who sells something and it's worth $1,000, for example, and if the person has a track record of selling 1 in every 4 people he or she talks to, then there's a 25% chance of the person selling it. So by, the expected value formula, you would just multiply the probability of the thing happening by the value of the thing happening, and then you get the expected value. So in that case, it'll be $250. So that would mean that the sales rep would have, like, the calls that the sales rep would make are worth $250 rather, because 1 in every 4 calls closes, and the thing costs, and the thing that they're selling costs $1,000. So it's really simple. You're just multiplying the probability by the thing happening. And when you see like the sigma and all this stuff, don't be scared of this. This is just iterating. So I just means that you're substituting in, something of a long list. But you can just pretend that the n and the i's and the sigma isn't there if you don't understand it. Just pretend it's x times the probability of x, and then just ignore all the sigma stuff and whatever. So that's pretty much it. And how does it relate to fundraising and whatever and what we're doing? Well, we look at what are called comparables. So typically we look at a few things. people in this industry, many people who are watching this, either setting up a fund or roll up or acquisition and so on. So lawyers, they charge, and there's an out-of-pocket risk, because the question that we always get a lot is, how much money should we spend on something before we spend money on it? Am I going to waste money? What do I do if I spend money on something and then it doesn't work? Well, that's what the expected value formula is supposed to help us solve. So we look at, what we do, we look at what's comparables, what other law firms have offered when they don't have the typical way of, being frugal, but at the same time making the most out of every buck and making the bang out of their buck. So the point I'm making is, the setup and so on of, we redacted some information, people charge like 40,000, law firms and so on. So it's like, okay, how do I learn the things that law firms do without me having to needlessly spend money, if sometimes some of the things that law firms are doing are really useful, extremely and necessary, and then there are other things that are doing that are just, shoehorned into something that I may or may not need, or something that I can figure out by myself, or something that I can figure out with somebody cheaper. How do you solve that problem, especially if you haven't done something before and you know that doing this is something that will benefit you? Well, we'll get to it. And same thing with investment banks. So it's like, okay, so even after you set up the deal, a lot of people come to you and they say, okay, it's 30 grand, it's 20 grand. And here's an investment bank that charges, 30 grand, 20 grand, and they take 5% at the end of the deal, and they take warrants as well. So, and they actually also charge for travel and expenses and so on. So, and then there also is like, okay, well, how do I do the financial analysis? I have to convince somebody to, split equity, or I have to find somebody to pay, and the average salary for a chartered financial analyst, which is one of the top credit, credentials that somebody can get, especially in North America when it comes to analyzing financials, is, 70,000. This is just Canadian bucks, which is like 50,000 in real US dollars at this time. And if you go to the official Chartered Financial Analyst website, obviously they pump up their program because they're the ones who are selling it, but they say that, hey, they're charging 126,000, 177,000, and we're just going to assume it's probably going to be the average of all this. It's probably like 100,000. And so how do you get all this expertise in a way that is 80-20, like it's in a way that is asymmetric, in a way that benefits you the most and helps you not go into basically being Santa Claus and spending dollars on things that won't even get your deal funded to begin with? Well, let's just walk through it. Let's walk through a few cases. So this first case is the traditional case. Let's say that somebody has a fund, GP, LP, setup, general partner, limited partner, setup, standard fund, where the person who's managing the assets, I guess the general partner or whatever, they're taking 2% of all of the revenue from managing the, like, whatever they're managing. So let's say they raise like $10 million and they're managing $10 million. Then they would take 2% of the $10 million that they're managing. So that's the management fee. So that's 2%. And they'll also take 20% of the revenue from the profits. Let's say they make 10% profits on that 10 million. Then they'll get whatever 10. So multiply 2% by 10%, they'll get 2,000. So that's what that were, and that's called the standard 2 and 20. So when it comes to traditional, we're going to assume the legal costs that we saw in some of the comparables, right? So we see legal costs of like 30K, like 30 to 29K. We put it in the comparables. We get the average of 35K. Investment bank costs 25K. And this is the out-of-pocket costs here. So we're not talking about success fee or warrants or whatever. We're just talking about the risk of you taking your money and then it's going down the toilets. And how do we manage that? So, we in red we just highlights all the things that are paid, so all the costs, and then we get the sum of it, right? And then when it comes to the revenue, we get all the revenues. So the revenue from the management fee, the revenue from the, the revenue from the profits, and then we get it all here, and then we get the sum of it. And so, as we said, we take the outcome, the sum of the revenue, multiplied by the probability to get the expected value in revenue. And we do the exact same when it comes to the costs, right? We take the sum of the cost, multiply by the probability, and we get the expected value of cost. So this is assuming that you worked in the traditional way, and there's a 50% chance of the deal closing, and there's a 50% chance of the deal not closing. We're given a lot of credits. We're going to say that if you do this, you're going to have a half chance of closing. We're just going to be really generous, and we're going to flip a coin if you close. So it could be very beneficial if you're somebody who raises, we put the thing at 3 million, and the reason why I put it at 3 million is because if we were to average out the raises.com, deals close within a few months or less, like quick deals closes, 3 months is 3 million is a good amount. So we would say the expected value, right? So unless you close, unless you raise over 3 mil, you're going to get the expected value of this, bam, which is pretty decent, right? But if you don't raise, if you raise only 1 million or less, then you'll be losing 10,000, 20,000, 28,000, 30,000. But then if you raise a lot, you make a lot more. So it's pretty decent, and it's a decent model, especially if you give a lot of credits to the traditional way of doing it. You can't lie. After you spend 50,000 minimum to even see anything, and then you give success fees, and then you consider paying for travel. So this is the traditional model, right? So then you look at the reduced, if you were to work with, somebody more thrifty like raises.com, and you were to do it in a non-brokered way, you didn't find any brokers, and you just went directly to, the investors in the non-brokered private placements in the compliant way. Number one, the legal costs would be reduced, because rather than, you getting a PPM from scratch from a lawyer and then taking a lot of time, and then they tell you things that you could have figured out on your own, or you could have gotten somebody else to figure out for you for cheaper, plus the things that they're needed to do, you would just get some things that somebody can tell you at a cheaper rate, and then get the things that are needed to do. For example, I can only speak for raises.com because that's the only company that I see in this side. It's where you're just giving you everything that you need for informational purpose, and then having the lawyer sign off on it and take that legal risk. So, and obviously removing some investment bank costs if you do it via non-brokered private placements. So what can that give you? Well, let's say that there's a 1% chance. Let's say that there's a 1% chance. So I'm going to even decrease the chance of anything happening, or not 1%, but 10% chance of this happening, right? So even if there's a 10% chance of this happening, the expected value, if you were to make this calculation, the expected value, you multiply the probability of it happening, just 1%, by it actually happening. Then you're getting, at worst case, if you raise $0, you lose $1,000. You use $600 if you raise, $100K, and then after that, then you gain $1,000, then you gain 3,000, then you gain, 11,000, and so on. Right? And so that's if you have a 10% chance of it going in your way, and it's way more than that. So let's say, and this is with, minus legal costs. So you're taking about $40,000 out of your pockets. So you're taking the gains from not spending $40,000 additional dollars as it's seen here or more, by adding that as well. And so that's the net. And so if you were to actually increase this, so let's say we're more generous and we're to say it's the same, then yes, the cost would be a bit less. And then we bring this back down, and then it becomes more similar to the above model, because we see that, there is a smaller loss than here. At worst it's this. At worst is this for 50%. But then when we hit that minimum $1 million raise, which is why raises.com, we typically work with people that are raising substantial amounts, then we start to see, the expected value rise pretty highly without you having a lot of risk when it comes to the amount that is put in. Next, when it comes to, let's say that you wanted to work with broker dealers, but you didn't want to work with the bad broker dealers, and you didn't know which broker dealers to work with and which ones to JV with, because there are some broker dealers that are exclusive and demand that you have to work with them exclusively, and then there are others that aren't. And so what if you were to work with a broker dealer that was that was less exclusive and more the other way, and we're just going to reduce this probability down to 10%. Then we see that this is the lowest risk hybrid, so it's like the lowest risk. So it's working. We're talking about like barely, like the expected value is about 10K, 28K for a $3 million raise, and for $10 million raise, the expected value is this, and the expected value just makes a lot of sense. And so what this means is that if somebody, for the accumulated time, if somebody wants to raise over whatever amounts is profitable here, whatever amount is net positive, that's the amount that it makes sense for in their situation, especially the fact that when you remove the legal costs, right? And so all this to say is the points of all this is, if somebody's raising 1 million, 2 million, 3 million, 10 million, and they consider the legal costs that they're paying, the investment bank costs that they're paying, and then they multiply by the probability with somebody that charges a lot, the probability of it being high with somebody that charges a lot, like I'm talking about 100,000, can actually make things more scary, especially if it's not done properly and you're not reducing those initial fees by setting everything up in a compliant way, in a way that is effective. And you can just see here by the way that the sum of the costs can also get multiplied, as well as the sum of the benefit. And so if you want to bring on people to your deal and you're working on raising capital, you want to talk about the benefits, like the cost of them not doing business with you and not joining on your fund from the rational point of view when it's late in the discussion. Because if you have this, then you'll be in that position, right? And then if you're also somebody who wants to consider working with Raises.com, just understand we really focus on getting the person to either, one, doing a non-brokered private placement so that they don't have to fall subject to people that charge, and try to control the deal, and so that people don't have to fall subject to getting large fees for no reason when we can provide a lot of the same information. But it would make more sense just for the legal sign-off for somebody to take that legal risk, because at this time, the time of this recording, we're not taking the legal risk because we're not the one offering the legal advice. It would be somebody else. So if you were to work with that in a hybrid way, or in that way, or you were to work with us to find the rights broker dealers so that you reduce the cost of you using a broker dealer that charges egregious amounts on top of the initial raise, including travel fees and everything, so that for your, let's say your $1 million plus raise, you can raise from low amounts to high amounts without any significant risk, and by reducing your legal fees by the amounts here, then that's pretty much where we're at. And looking at everything and looking at the expenses and getting this all set up and doing the underwriting, it's really just to hit the markets and then to see how can you raise for your fund quickly without some of this nonsense. And if you want to make get an expected value of $1 million, why not? So with this, I hope this video makes any sense, and it makes sense. And then whatever the cost of doing business with Raises.com is, it's really relative to the expected value you'd get. And I look forward to seeing you either probably on the inside or somewhere else. And so we'll see you in the next video.